Donald Trump signs a new executive order cracking down on debanking. What is it? How big a problem is it? And how much will this order actually do to combat the practice?
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome to the Potomac Watch podcast, the daily podcast of the Wall Street Journal editorial page. I'm Kim Strassel, your host today, and I'm joined by two colleagues who last I knew had not been debanked, but nonetheless know a lot about the question, Alicia Finley and Mene Ukwe-Barua. Before we even get to the executive order, let's just talk about the issue for a second. Debanking is the circumstance in which an individual or an entity in an industry loses access to financial services, often because they are declared, and even though they may not be told this, a reputational risk for the bank. No less than Donald Trump says it has happened to him. Let's hear him talk about the experience.
Well, I had hundreds of millions. I had many accounts loaded up with cash. I was loaded up with cash, and they told me, I'm sorry, sir, we can't have you. You have 20 days to get out. Then what happens is I call up Bank of America routinely, and I speak to him, and I speak to a couple of people, and they have zero interest. I ended up going to small banks all over the place. I mean, I was putting 10 million here, 10 million there, did 5 million, 10 million, 12 million. I have them all over the place, the craziest thing. And that's because the banks discriminated against me very badly. And I was very good to the banks. I had the greatest economy in the history of our country when I was president. They totally discriminated against, I think me maybe even more, but they discriminated against many conservatives. You know, I told that story and sitting around tables with other people that were conservative or Trump supporters. I think the word might be Trump supporters more than conservative.
Other prominent people have claimed that they've been debanked. There are entire sectors like crypto world that make claims too, conservative organizations, down to average folks who say they've just been tagged maybe because of their last name or their religious affiliation. In a hearing earlier this year at the Senate Banking Committee, there was a number thrown around that the Consumer Financial Protection Bureau had received 12,000 complaints about this in the past 3 years alone. The banks fault regulators, and it strikes me that that is really the problem. Alicia, can you tell us how this works in practice? What happens?
So what has happened in the past is, going back to the 1990s, the bank regulators started grading banks based on their reputational risk. And what that means is that if they provided accounts or loans or provided other financial services to certain industries or groups that were deemed a reputational risk, and during the Obama administration, the FDIC examiners applied this label to a host of unsavory businesses, for instance, pawn shops, payday lenders, gun retailers. And when that happens, banks essentially are de facto have to stop providing services. And that includes bank accounts or any other kinds of asset or asset management for these kinds of businesses, because they don't want to get a bad grade by the regulators, because that can prevent them from undertaking all kinds of activities, including growing or merging. So that is one issue that's been that has led to a lot of businesses being debanked. Now, another second issue that really seems to have cropped up more after the January 6th riots, is that banks have to comply with the Bank Secrecy Act. And this is essentially what people colloquially call know your customer rules. So they have to collect all kinds of information, and if there's anything suspicious in terms of transactions, they have to flag it and file a suspicious activity report with Treasury's quote-unquote FinCEN database. Now, regulators and law enforcement have access to this database and can essentially use it to investigate people without a warrant. So what happened after the January 6th riots is that the FBI and some Treasury officials put pressure on the banks by quote unquote suggesting or recommending that banks flag certain individuals that appear to have been tied to the riots in this FinCEN database, so they could essentially investigate them without actually getting search warrants. And as a result of flagging these individuals, they were deemed kind of high risk, and banks, as a result, effectively had to close their accounts because they didn't want to get on the wrong or bad side of regulators. And because when you are banking or providing services to a quote high risk individual, there are more compliance burdens involved in that. And there's also the risk that regulators may later come after you. And if this certain individual is convicted of crime, money laundering, or anything else, the banks could also be forced to pay hundreds of millions of dollars in penalties.
And just to be clear, because I think this is really important to get out there, if you listen to some on the left, they'd like to say, well, the big bad banks, and look, they're shutting down people because of the, employment, et cetera. But I mean, the banks, my understanding, have been essentially begging for changes here. This really is a regulator driven and a congressional law driven problem, right, Alicia?
Absolutely. They've been begging the regulators to stop rating them on reputational risks because it does restrict to whom they can lend. They've also been begging Congress, and I've been listening to appeals from banking groups going back for more than a decade to reform the Bank Secrecy Act, which requires them to file all these suspicious activity reports because it's an enormous compliance burden. And it also basically restricts them from lending to certain or providing services to certain customers who aren't criminal. So yes, they would like to be liberated from the regulators so they don't have to debank individuals.
So something clearly needs to be done, Monet, and my understanding is that some of these regulators had eased up a little bit after Donald Trump had been inaugurated. But Trump on Thursday signed this new executive order. It has a lot of different pieces to it, some of it directed at regulators to change practices, but also some notable orders, which is interesting in terms of what could come from a follow-on for them to investigate prior complaints and refer some of them to the Attorney General, and also to help restore clients that have been debanked. Monet, what exactly does this order do? And do you think that it is going to help in some ways?
Well, the order is very broad and has a few distinct sections to it. I think before even getting into the policy changes, it's worth commenting on the introductory section of the order, which is a fascinating bit of political rhetoric. It begins by essentially describing the trend of debanking that has existed in the United States for the past couple of decades and why reforms are necessary. But instead of focusing on some of the best substantiated cases, like the things Alicia mentioned, targeting cryptocurrency firms and things like Operation Choke Point during the Obama administration, it talks about targeting of ordinary conservatives, particularly people who were involved in January 6th. The idea is that those people were denied banking services. And then it says some people were subjected to investigations based on essentially ordinary tastes, like buying things from Cabela's, which is a famous hunting gear supply company, yes. Along with Bass Pro Shops. And so this is Trump essentially saying, or the White House essentially saying that this is something that affects all conservatives. It's not just cryptocurrency. It's not just President Trump himself. That federal regulators have used debanking as a way of targeting conservatives in general. And there may be some truth to that. I think, as I mentioned, those cases are not nearly as well substantiated as some of the more solid claims, like the pursuit of cryptocurrency firms. But that's definitely part of the argument that they're making, and that's going to be part of the ongoing conversation about debanking, whether ordinary people are being swept up into it. But on policy terms, it has three distinct sections. The first is essentially codifying the rescinding reputational risk as a factor that the three big bank regulators can use to evaluate banks and force them to close particular accounts. So as you mentioned, the regulators have already done this voluntarily, but the executive order wants to make that more substantial by making it an official White House policy across all agencies. Then it directs the Small Business Administration to basically say that all of the banks that are originating small business loans have to be aware that they're not allowed to consider political considerations in originating these loans and deny people of services, of depository services, based on their politics. And interestingly enough, it says that banks that have done this in the past have to actually reach out to the customers who they denied and reinstate their accounts. So it's retroactively saying that you need to rebank the debanked. And then the final section essentially is telling the Treasury Department to look across the entire sweep of regulations that could result in debanking. So we're not just going to change the reputational risk standard, but what other provisions might there be throughout the entire range of financial regulators that contribute to debanking, and to try to change those. So it's a much more open-ended change. So this is clearly something that the White House is prioritizing and wants not just a small piecemeal change by the bank regulators, but wants to have it be a whole of government, essentially, approach.
I'm still really stressed by your point about Cabela's and Bass Pro Shops. As a loyal customer of those facilities, I'm going to be watching my bank statements very closely. This all sounds like it's for the good, but Alicia, aren't there limits to this? Meaning, if it's an executive order, what happens when the next president comes in? And I mention this because there is no question that while there's a generalized problem of debanking and regulators and these reputational risk rules, it has also been the case that Democratic administrations in particular have used this to their policy advantage by purposely having people having regulators crack down on industries that they do not approve of. So you mentioned Operation Choke Point, which really took aim at firearms vendors and pawn shops, payday lenders. Biden similarly really wanted banks to crack down on those that engage a lot in firearm sales. He used it against the crypto industry. So my fear is that what happens is that you get a new president who comes in and just reverses this. I know you have looked, and I believe your views probably with mine is that maybe a better way to go is with legislation. Tim Scott, the senator from South Carolina, has been very involved in this. He held hearings on this issue this year. One interesting aspect of this is even his ranking member, Elizabeth Warren, agreed that there was a debanking problem, although her solution was to further give powers to the Consumer Financial Protection Bureau to investigate, which made me laugh because she's essentially saying that we should have one set of government regulators investigate the actions of a second set of government regulators. Tim Scott instead has come up with some legislation to tackle this. Let's just listen to him quickly on what he's proposing.
What we do is we eliminate reputational risk is what they're using. The OCC, FDIC.
Right. I had that in my riff. Yes, that's one of their weapons.
So important. And it is such a big weapon they use on steroids against conservatives. What I want to do is eliminate that. Good news is I've had a lot of cooperation from the banking regulators, the OCC and the FDIC under President Trump's leadership. I've been able to move them in the right direction. So I'm very thankful for the new relationship that the American people will have with the bank regulators.
So, Alicia, this is talking about formalizing some of the things that are in that executive order. Do you agree that's the better way to go? Why do we need legislation, and what else might this legislation do?
I think that's exactly right. You really need to codify this into law, because otherwise you can get another Democratic administration, or for that matter, a Republican administration, or Donald Trump could change his mind and decide, well, no, maybe we do want to use the banks to crack down on certain groups or industries, for instance, abortion providers. So just to underline that liberals have as much at stake in this as conservatives do. And that brings us to the point of why legislation is needed. Now, Tim Scott has introduced that bill that would bar regulators from considering reputational risk when they grade banks. Companion legislation is in the House by Andy Barr, a Kentucky Republican, and Rishi Torres from New York that would similarly bar regulators from using quote unquote reputational risk as a justification to essentially deny financial services to otherwise lawful businesses. And notably, this actually has gotten bipartisan support in the past, and there was kind of a compromise that was forming at one point that would bar reputational risk, but in return for providing banking service or allowing banks to provide services to marijuana businesses. Now, I don't support the latter, but I think it just shows that the bipartisan compromise is possible. Maybe give Democrats something in return that they're looking for that wouldn't be provide regulators more opportunities to overreach. You mentioned Elizabeth Warren, and she wants to give the CFPB more powers to regulate or review debanking of individuals and investigate banks. Rohit Chopra, ironically, or maybe not so ironically, he actually used this debanking excuse to extend the CFPB's jurisdiction last year over all kinds of transaction or payment apps, which it didn't have, and now that rule making is being reversed by the Trump administration. But it would be much better if Congress specifically acted rather than essentially letting regulators change the rules every time there's a new administration.
Yeah, and Monet, Alicia also mentioned in her opening comments that the other piece of this is a problem is this legislation known as the Bank Secrecy Act. And this is a law that essentially requires banks to build profiles on customers and monitor their activity and then file these suspicious activity reports with the Treasury Department if they suspect illicit activity. And, really small things, by the way, can catch you up on those SARs. I've actually heard from folks or small business owners, especially small business owners that deal in a lot of cash money. If you make too many cash deposits in a short enough period of time, you get flagged with an SAR. There's a lot of things that can trigger these. Of course, this was intended for good purposes to try to, make sure people weren't engaged in money laundering and other illicit activities and to make sure banks know your customers. But the feds have abused it. And I'm not sure that anyone is addressing this. I mean, Monet, do you think this is a piece of this that's going to have to be reformed by Congress if we really want to get rid of debanking too?
Yes, I definitely think so. It's very clear that the SARs, as you mentioned, it's just a little bit too subjective. Essentially, the investigators propose a whole bunch of different factors which banks are supposed to flag as suspicious transactions, but aren't themselves necessarily reliable indicators of any kind of crime. And so you have a lot of ordinary individuals or small businesses in particular that are regularly being flagged. And one of the difficulties of the SAR standard is that the banks themselves are not supposed to inform the people who they flag that they have been flagged. And so that means you don't have the opportunity to adjust your behavior to make sure that your services aren't going to be affected, or make a case to defend yourself before they could. You could just be notified by your bank at some point that your account is being closed, not understand why. But the banks have no choice but to comply with this, because if they end up not flagging someone who does turn out to be engaged in money laundering or some other financial crime, then they could be slapped with a big investigation that will be very burdensome for themselves, or fines as well. And so obviously the federal government needs to have provisions in place to make sure that money laundering is difficult and to make sure that banks are engaged in trying to monitor it. But just in practice, we've seen that the existing standards aren't accomplishing that so well. And so some kind of reform should be done. And this probably would pair very well with whatever Congress does to address debanking more broadly.
Yes, this is a problem with a law called the Bank Secrecy Act, as it's very secret, and it's causing a lot of problems. I mean, I think probably the answer here are some tweaks and changes, because it does have some useful purposes, but it's something Congress is going to have to wrap its head around if it really wants to deal with this. I want to bring up just one more issue. Because it's a different way of looking at this problem. In a hearing that Tim Scott did back in February, he had a fascinating witness, the CEO of a bank called Old Glory Bank, which was actually started in response to conservative complaints of debanking. And the bank's entire pitch line is that they offer cancel-proof products. But this CEO, Mike Ring, made a really notable point. He cited a statistic. He said we've lost 73% of our banks in the past 40 years. There was another set of stats from a House hearing in May where a witness noted that we have 4,487 banks in the United States, nearly 50% lower than the number was in 2005. And of the banks acting today, only 85 were established after 2010. And that year is notable because it's the year we passed Dodd-Frank that did make banking tougher. And it's a huge problem because what it means, and this was Mike Ring's point, is that there's less choice out there. More and more people are banking with just a handful of big banks. You know, they're with Wells Fargo or they're with Chase. And those banks all happen to be the most sensitive to regulators. So there's less competition. And also notable, if the real goal here is to actually know your customer, that used to happen a lot more because people banked locally. And by the way, I still bank locally, and I love that they know who I am when I walk in my bank. So there's actually this interesting effort, separate from this, Alicia, to pass legislation that would make regulatory and capital and merger and acquisition requirements a lot more sensible to try to inspire more bank formation. Do you think that would help as well, too?
So a big issue has been the Dodd-Frank Act with all these regulations really help the big banks essentially create this moat because the compliance burdens fall disproportionately among the smaller community banks and mid-sized banks. Now that's why you've seen a lot of bank mergers is because there's kind of an economies of scale. When you grow by merging, the actual compliance burdens are become somewhat diminished. Now, there was also an effort in Congress, the Crapo bill during the first Trump administration that reduced many of the compliance burdens and prudential rules. And by that, I mean capital, liquidity, and other standards for many of the mid-sized banks. So it ensured that the regional smaller banks wouldn't have to play by the same rules as the big, what we call SIFIs, systemically important financial institutions. Now, I think there's a good reason to continue that movement toward deregulation. Some of this, I think the reduction in banks is just a natural consequence of technology. Bigger firms have basically the resources to invest in more and better technology, online banking, to provide services to more customers. And so I'm not sure, to some extent, these trends are probably going to continue, but allowing these kind of smaller mid-sized banks to compete, providing them the opportunity to compete with the bigger sized banks by allowing more mergers and acquisitions, I think could help with competition.
Yeah, having even a little bit more competition, I think, would be a very valuable addition to all this as well, too. Thank you, Alicia. Thank you, Monet. Thank you to our listeners. We are here every weekday, and we will be back on Monday. If you enjoyed the show, please do subscribe, and you can write to us at pwpodcast@wsj.com. We love to hear your thoughts.